Okay, so in this video, I want to talk about this contribution number, or also known as a premium. Now, I don't like to use the word premium because if you think about premiums in car insurance or maybe even health insurance or even term life insurance and even some whole life insurance policies, if you don't make that payment, the whole policy cancels and you lose everything. But in this particular case with these policies, the way we design them, there's a lot more flexibility in this number. So if you lose your job or if you have a financial setback and you can't make that payment one year, then it's okay. Plus you can make this payment monthly, quarterly, semi-annually, and basically however you want to do it. Now, I want to talk about the flexibility and some of the things to know about this particular payment, because this is the amount that you need to contribute to the plan to be able to borrow all this money to pay back those college loans. So a lot of times people see these big numbers like $2,000 a month and they think, holy cow, I can't afford $2,000 a month. Well, if you can't afford $2,000 a month, then you might not be able to afford the cost of college that we're estimating here. So we are looking at what we think the cost of college is going to be and what those college loan payments are going to cost you. So we can't really control much about this depending on which schools you choose and things like that. So if you're going to go to a certain, or if your kids are going to go to a certain school and it's going to cost this much, then we've got to get the money into the plan to be able to borrow against it, right? Now, we could spread that payment over a longer period of time because we're going to be making those loan payments until, down here. So you can spread these payments out over longer. Or if you already have a lot of college savings or other money that you can use, maybe you can, get it done in 5 years is about the shortest time that you could do. But we could do 5 years, we could do 10, 15, 20, depending on how young your kids are. We could spread it out quite a while. We could even take out some home equity and pay off the college loans with home equity and spread the payments out over 30 years if you wanted to. But a lot of people don't want to be paying for college into their 70s and 80s. And so this amount of time is very, very flexible. Okay, you don't have to stick to any particular plan as far as the length of time goes. So if you decide you want to do 8 years instead of 10, that's fine. Nobody is holding your feet to the fire on the amount of time that you're doing, making those payments. So there is some flexibility. However, life insurance isn't as flexible as, let's say, a 529 account. With a 529 account, there's an annual limit that you can put in every year, but you could put in birthday money, you could put in, random lumps of money here and there. If you received a big inheritance, you might not be able to put the whole inheritance into a 529 account, but you could put it into a mutual fund or something like that. But life insurance, you can't put a big lump sum in. So to kind of explain how this whole contribution number works and how this so-called premium number works, I want to kind of use a different example or a different presentation to kind of show you a little bit about this number here, this contribution number, and I also want to talk about this number here. So remember the $24,000 a year, and remember this random life insurance number of $859,744. Totally random amount of life insurance. So why did we choose this amount of life insurance based on this $24,000 a year? So that's what I want to show you right here. Okay, so I want to talk a little bit about all these numbers with life insurance. Let's say that we're looking at a $500,000 death benefit, okay? $500,000 of insurance. There is a minimum that you can pay for that $500,000 of insurance. And most people don't know this, but there is a maximum that you can pay for this $500,000 of insurance. Now, the insurance company, they're the ones that actually sets that minimum. And believe it or not, the government is the one that sets the maximum that you can pay for that $500,000 of insurance. Okay, so there's a number of different ways that you can design a life insurance policy from the minimum to the maximum, right? Now, in the 1980s, they came out with what we call qualified plans. That's going to be like your IRAs, your 401ks, SEPs, Simples, all these qualified plans. They also came out with what we call a MEC or a MEC guideline, or also known as a modified endowment contract. Now, why does the government care about how much money you pay for this $500,000 of insurance? Well, because the money you pay into this life insurance is going to grow tax-free. And if you take it out through the loans, you're going to be able to access all the money tax-free as well. Some people call it the rich person's Roth IRA. So the wealthy people figured out way back in the 80s, they figured out that, hey, they could buy this little life insurance policy and drop $1 million or more into these policies, and all that money could grow income tax-free, and they could access all the money tax-free as well. Well, the government figured this out, and they put in these MEC guidelines, or these rules, to regulate how much money you could pay or how much money you could contribute into the life insurance, right? So the minimum is kind of like what you would think about when you're thinking about term insurance. In this example, we'll use $500 a year for $500,000 of insurance. And then for this example, we're going to use $10,000 for the maximum. Okay, so the maximum is what the government is setting. Now, if you pay the minimum, all you're really going to get is term insurance, okay? Also, you're just going to get the death benefit. There's really no living benefits. So some of you might not be, as familiar with all of these, what we call living benefits. You might just know life insurance for its death benefits. Well, yes, it's true. Life insurance, most commonly the term insurance, is only going to have a death benefit. But if you want all of these benefits, like tax-deferred growth on your money, okay, tax-free distributions of the money, okay, competitive returns, high contributions that you can contribute, that are way more than you could put into a 529 plan, or way more than you could put into an IRA or even a 401k. You can put a lot of money into these life insurance plans if set up correctly. Additional benefits that they come with, there's riders that life insurance can come with. Collateral opportunities. The big thing that I'm always talking about is using your life insurance cash value as collateral to borrow against. Okay? It's safe. It's safe from lawsuits, creditors, bankruptcies in some states. No loss provisions. If the stock market crashes, this particular type of life insurance is guaranteed to never lose in the stock market. Guaranteed loan options, meaning you're guaranteed to be able to borrow the money. There's no qualification or credit check. You can borrow the money from the insurance company to access your money. Unstructured loan payments. You can pay back those loans anytime you want or wait until you die and they can get paid back at death. All right. Liquidity, use, and control of your money. That is super valuable. I would rather have access to my money than a big rate of return. Sometimes having access to your money is more valuable than you think. And deductible contributions, which is the only one that you can't get in this particular example, which I'll show you. But the less you pay for the life insurance, in other words, the closer to this number that you get, the least of these benefits that you're going to get, okay? So you're basically only going to get the death benefit, which, like I said, is typically term insurance. So the more you pay for the life insurance, the more of these benefits that you're going to get, okay? Now, like I said, the only one you can't get is deductible contributions. You can't deduct the money on your taxes that goes into the life insurance and then access it tax-free, all right? So it's kind of like a Roth IRA. You pay your money first, you pay your taxes on your money that you earn, and then the money goes into the life insurance and can grow tax-free from there. All right, now, if you go right up to this line, it's called a maximum efficient contract. That's what we call it anyway. Okay, a maximum efficient contract is when you're taking advantage of all of these benefits, not just some of these benefits. So could you pay, let's say, $5,000 a year? Absolutely. We could pay $5,000 a year. All right, that's the minimum. 500 is the minimum. So we could easily pay $5,000 a year. That's fine, but we're still going to be paying the same expenses for this amount of insurance. So could you pay $3,000 one year? Absolutely. Okay. If you have money in your account, you don't even have to make a payment at all because they could just take the expenses out of your account. So some years you could skip payments altogether. During COVID, we had lots of clients that were putting payments on hold. We had people borrowing money early. We had people lowering their payments. and that's totally fine. Okay, there's a minimum that the insurance company needs, and there's the maximum that the IRS will let you contribute. Now, let's say that one year you contribute $5,000 instead of $10,000. Well, then the next year or in subsequent years, you could make up for the $5,000 that you didn't contribute that year. So you can actually play catch up if you wanted to. Unlike, like a Roth IRA or IRAs, you can't play catch up in those, but you can play catch up in the life insurance, okay? So hopefully this helps. The goal is to be able to put in the maximum amount up to what the IRS guidelines are. So we don't want to create a MEC. We want to avoid the MEC. We want to come right up to it and have what we call a maximum efficient contract. Okay, so coming back to our numbers, if we're looking at $24,000 a year as the amount that we want to contribute, okay, then the IRS is the one that comes up with this $859,744 of life insurance. That is the lowest amount of life insurance we can buy, okay? So could we ever put in, $36,000 one year? No. If we received an inheritance, could we drop in $100,000? No. Okay, so that is the maximum we can contribute, not the minimum that we have to contribute. That's the maximum that we can contribute. Okay, now if we, purchased a different amount of life insurance, let's say we bought $1 million of life insurance, then the government would tell us what the maximum number is that we could contribute based on $1 million of insurance. So you either have to come up with the amount of life insurance that you want, or you have to come up with the amount of money you want to save. So some families might want to start out saving $1,000 a month, and then within 3 to 6 months or a year, they want to get up to the $24,000 a year goal or something like that. So there's some flexibility in how the money goes into the plan, but you have this maximum amount that the IRS specifies, and then you have the amount of life insurance that the government requires. Okay, so what is the minimum? Well, technically, the minimum is this. Now, each insurance company has a certain amount that they want you to contribute the first year and maybe even a few years after that. But for the most part, the insurance company needs the expenses. That's basically the minimum for the most part, okay? Now, it's the first year that's kind of tricky because in the first year, you don't have any money in your available cash value yet, or not much, okay? So for the first year, you have to, be able to put in enough to hit the insurance company's minimum. Now, after that, as long as you have enough money in your account to cover those fees, this money here could be used to pay those expenses. So technically, when you make a contribution of $24,000, that goes into your account. All right, well, it goes into your account and then you have a certain amount of that available, right? So whatever is in the available cash value, that is what can be used to help cover those expenses, okay? All right, so in other words, if you look at right here, in about the third year for this client, they're potentially generating enough interest to cover those expenses. Plus, as time goes on, look at the amount of interest that you're earning. That's why you could stop after 5 years. Maybe you could stop after 10 years. Maybe you could keep going for 15, then stop. But you'll notice that this client isn't putting in any more money after 10 years. Now, could they? Yeah, they could if they wanted to. Could they quit after 8 years and not do those last 2? They could do that as well, okay? But once they stop, where's the insurance company coming up with those expenses? Well, the insurance company is coming up with those expenses out of your available cash value, right? Which is being generated and increased by your account value and the interest that you're earning on your account value, okay? Okay, so to tie all this together, I want to use one more analogy that will hopefully help all of this make sense. I want you to think of this 7-story apartment building. Okay, so if you're a real estate investor and you're going to go out and buy a 7-story apartment building, okay, you're going to have some fixed expenses. You're going to have the mortgage payment, the property taxes, the homeowner's insurance, okay? You're going to have some of these fixed expenses, and then you might have a couple of, variable costs like utilities. But for the most part, you're going to be paying for this 7-story apartment building. So would it make any sense to only fill up 3 stories of tenants if you own a 7-story apartment building? No. So if you only plan on filling 3 stories of tenants, you should buy a 3-story apartment building so that all of these expenses are less, right? So could you fill up 3 stories? Absolutely. Could you fill up, 5 stories? Absolutely, okay? But that doesn't change these fixed expenses. It might change a few variable expenses or, a few of those variable costs, but for the most part, the majority of your expenses are tied to this 7-story apartment building. So it behooves you to be able to maximize the efficiency of this piece of real estate by putting, 7 stories full of tenants. Right? That is going to be your maximum efficient apartment complex. The same thing is true with life insurance, okay? There are, some fixed expenses and a few variable expenses, but for the most part, the cost of the life insurance depends on the amount of insurance that you buy. So if you buy $1 million worth of insurance, okay, the IRS is going to tell you how much you can put into that to where it's maximum efficient, okay? Maximum efficiency. So if you buy a $1 million policy, you might as well put in the maximum amount that the IRS will allow you. If you only buy, a $500,000 policy, then you're only going to be able to put in, enough money to max that out, right? So you have to ask yourself, what is the maximum amount that I think I'm going to be able to put in on a monthly or on an annual basis, right? Now, if your financial situation is going to change in the next 6 months to a year, maybe you start out, with a little bit less and work your way up over that first year or so. But if your financial situation is not going to change for 2 to 3 or even 4 or 5 years down the road, then it would be better to buy a smaller policy, max it out for maximum efficiency, and then in 3 to 5 years, get another policy. Yes, you can have multiple policies on the same individual. You could also do a policy on you or on your spouse or even policies on your kids, okay? But it's better to go with maximum efficiency. Now, here's a little secret. Insurance agents get paid based on the building that you buy, just like a realtor is going to get paid based on you buying a 7-story apartment building. But if you don't plan on filling more than 3 stories, it doesn't make sense to buy a 7-story apartment building, right? Same thing with life insurance. The insurance agents get paid commissions on this number here or this number here. So you want to buy the smallest amount of insurance required by the IRS to be able to put in the maximum amount that you want to put in on a regular basis.